Welcome to Talk Tickers. Today we are breaking down an absolutely explosive quarter from Climb Global Solutions, ticker CLMB. The company didn't just beat expectations on their latest report, they pretty much blew them out of the water. All right, let's get right into it.
So here's the big question on everyone's mind. How on earth does a company that's seen as a niche distributor pull off numbers like these? We're talking a 73% jump in revenue and earnings that crushed estimates by 40%. Well, we're going to unpack exactly how they did it.
All right, here's how we're going to break it down. First, we'll hit the headline numbers themselves. Then we'll dig into the strategy that's making it all work. After that, we'll decode what management said on the analyst call, see how the market reacted, and finally, we'll give you our take on what to watch for next.
Okay, first up, the results. And let me be clear, this wasn't just a narrow beat. This was a complete and total show of strength across every single important metric.
The first number that just leaps off the page is on the bottom line. Adjusted earnings per share, or EPS, came in at $1.39. The consensus was 99 cents. That is a 40-cent or 40% beat. It's a huge signal of just how much profit they're squeezing out of every dollar of revenue.
And the top line? Just as impressive. Revenue was up 73% from the same time last year. Now, what's really important here is that this wasn't just some one-off event. It was a mix of really strong double-digit organic growth, that's their core business, plus the smart acquisition of Douglas Stewart, or DSS.
And when you put it all together, you can just see the outperformance was everywhere. Gross billings, that's a key metric for them, jumped 39% to over $500 million for the quarter, and adjusted EBITDA up a massive 64%. You really can't find a weak spot here. This was just flawless execution, plain and simple.
So results like that don't just happen by accident, right? They come from having a really clear strategy. So let's look at how Climb is managing to win against distributors that are 10, even 20 times its size.
It really boils down to this three-part formula. First, they're making smart, targeted acquisitions, like that DSS deal, which plugged them right into the education market just in time for its strongest season. Second, they are incredibly picky about which partners they work with. And third, they have a new ERP system that's finally up and running, which should make them way more efficient down the road.
You know, this quote from CEO Dale Foster on the earnings call says it all. This isn't about just collecting as many vendor logos as possible. It is all about curation. Looking at 50 potential partners and then choosing only 4, that shows a laser focus on quality, not quantity. And it's clearly working.
Okay, the headline numbers are great, but the real story, the real nuance, often comes out during the question and answer session with the analysts. So let's dig into the conference call and see what management was really telling us.
This really breaks down the most important conversations. Analysts, of course, jumped right on the unusually high margins and asked, hey, is this the new normal? Management was very straight up about it. No, it's not. It was because of a few big, high-margin deals. They also confirmed that one very large deal got pulled into this quarter from the next one, but they made sure to stress that even without it, the core business was still growing like crazy. As for the future, they're still on the hunt for small strategic deals they can pay for with cash.
So you've got a blowout report, you've got confident commentary from management. How did Wall Street react to all this? Well, in a word, they loved it.
And this chart really puts it all into perspective. Over the past year, Climb stock is up 52%. I mean, that is just crushing the broader tech sector and the S&P 500. The market took this news, reevaluated the company, and pushed the stock way higher, confirming that investors believe the success story is real.
Okay, so that brings us to the most important question of all. What does this mean for the stock going forward? It's time for our take, our outlook, and our official rating on Climb Global Solutions.
Now, before we give you our rating, I just want to be super clear on our framework. When we say outperform, we mean that we expect the stock to do better than its benchmark over the next 12 months. It's our highest conviction call.
So here's our thesis. In the near term, for Q3, you should probably expect the crazy growth numbers to cool off a bit. They now have to compare their results to last year's really strong quarter with the DSS acquisition, and remember, that one big deal was pulled forward. But looking ahead, the real things to watch are better margins from that new ERP system and more high-growth vendors being added. The stock has had a great run, yes, but we think its strategy, its clean balance sheet, and the huge market it operates in all justify it. For all these reasons, we are officially assigning an outperform rating.
Climb has proven it can execute and execute well. The big question now is whether this amazing quarter was a one-hit wonder or the start of a whole new chapter of growth. We'll definitely be watching. As always, this analysis is for informational purposes only. It is not financial advice.